This is probably the number one question I get asked. Stay tuned to find out my take on the markets. Hey, it's Yama. Welcome to the Section 8 Sensei. Today we're going to kind of take a look at interest rates and try to figure out where they might be going down the road here in the near future. If you haven't already, please subscribe to the channel, turn on your notifications, and get ready to learn a little bit about the markets. All right, so generally speaking, interest rates are going to vary by company, borrower profile, transaction type, etc. So sometimes I take these calls and, hey, I was just calling. Just want to see what's your interest rate on what. It's like saying, hey, I want to buy a car. That's it. So, it's too general of a question. It depends on credit scores, depends on your transaction type, your loan to value, what are you buying, how much you're borrowing, your debt to income ratio. All of these things play a part in determining what your final deal is. Obviously, we did a couple videos on LLPAs, which are loan level price adjustments. So you can kind of see where the risk is, what kind of loan you're doing. Are you going full doc? You're going non-QM, bank statements. So there's 100 different factors that come into it. So hey, just want to see what your interest rate was is a little bit too general of a question. I know everybody wants to ask it, but there's too many factors that are involved in it. The one thing that you can always do, obviously, people that are in the industry follow different systems and information subscriptions and stuff like that to try to figure some of this stuff out. But generally speaking, the public, if you just want to watch the 10-year treasury, kind of add 2.5% to 3% of it, that's usually kind of where the markets are hovering, generally speaking. Obviously, again, it depends on all those other factors we talked about, but it'll kind of give you an idea. And that at least gives you a baseline to start with on something you can watch every day other than just guessing. All right, so I get this a lot too. I know a lot of people are watching the news. News talks about the Fed, talks about Fed interest rate cuts, et cetera, et cetera. So let me know what you guys think. When the Fed cuts rates and you hear a rate cut announcement, on the news or whatever, how does that affect mortgage rates? So kind of give me your thoughts on what happens to mortgage rates when the Fed does their rate cut, and put it in the comment section below. All right, so all of these things that happen in the interest rate world and whatnot are tied to what's called mortgage-backed securities. So mortgage-backed securities are basically it's a type of bond that investors and can purchase through the bond market. Okay, so this provides liquidity to the real estate market, and large companies, the government, commercial banks, et cetera, are the ones that buy these. So you guys probably don't realize, but when COVID hit, back in 2020, right, the spring of 2020, the mortgage market came to a halt for a really short window of time, because when that happened and the rates started to drop, the average loan volume, so to speak, that happens in the marketplace was about $5 trillion a year amongst all mortgage lenders in the country. Okay, so $5 trillion a year. In the spring of 2020, there were $5 trillion in loans in the pipeline to close. So it was going to blow the system sideways. So that's when the government had to step in and say, hey, we'll buy $80 bazillion in treasuries for the next foreseeable future. And they bought all this paper, which kept the pipeline flowing. Otherwise, we were going to be in some deep doo-doo. So anyway, that's kind of how the mortgage-backed security thing works, and kind of what happened to it, when it runs out of gas. And that's usually when the Fed step in and they got to start buying bonds. Okay, so then you have a thing called the Fed funds rate. Okay, so the Fed funds rate is essentially the rate that the Feds charge to banks to borrow money overnight, essentially. Okay, so it's about 5.25%, 5.5% right now. So most people don't see that part of it, but that kind of turns into kind of what you see with what's called the prime rate. So prime is what they base HELOCs or lines of credit off of. They're tied to credit cards, car loans, things like that, and other adjustable base interest rate products, basically. Okay, so anything you have, like if you look at your credit card statements, it'll say, hey, your credit card interest is the prime rate plus some margin. Okay, so the prime is what's called an index And then a margin is what you add to that index to create what's called a fully indexed rate. So that's kind of the rate of interest that you get charged based on a moving index. So the margin always stays the same. The index is what moves up and down. Okay. So, when that happens, the Fed funds rate runs about 3%, give or take, less than what you see on the prime rate. Okay. So anytime you see a rate hike, rate cut, all this stuff in the news or whatever, that's basically a move to the Fed funds rate, which is kind of tied to prime. So if you see, coming up in the September meeting, let's say you say, hey, there's going to be a 50 basis point rate cut, you're probably going to see prime drop from 8.5 to 8. Okay, because the Fed funds rate is probably going to drop from 5.5 to 5 or to 4.75 or whatever. Okay, so that's kind of how it's tied. They're not tied to mortgage rates. So if you see a 0.5 point rate cut, that doesn't mean the interest rates in the market just went from 7 to 6.5. That's not what happened. Okay, so those are only affecting those two instruments and not mortgage rates directly. Okay, so right now what everybody's hoping for is obviously for rates to go down. So in order for that to happen, two things are kind of on the deck right now. We're looking for inflation to go down, which will bring rates down, and we're looking for unemployment to go up. All right, now I know that sounds not good, but the unemployment rate going up and inflation coming down are what's going to drive the interest rate market south. Okay, so if you're just hoping for low interest rates, and obviously also hope that you're not one of the unemployed, okay? But if you're hoping for interest rates to drop, you're basically looking for, again, inflation to go down, unemployment to go up, and that's what's going to move your numbers. All right, hey, I found this information here that I thought might be good for you guys to see, just because sometimes you look at historical data and it's kind of a precursor of things to come in the future, so to speak. So anyway, so this thing called the SAM rule that a lot of people follow that are in the economy side of things. And so it was created by somebody named Claudia Sam, who was a former Fed economist. And basically what the rule is it's that if the unemployment rate is 0.5% above, if the 3-month moving average of the unemployment rate is 0.5 above the lowest point in the last 12 months for that unemployment rate, and that happens for 3 months in a row on the average, that we are in a recession or will be in one coming up. Okay, so it's either a precursor or you're sitting in the hole right now. So there's been 12 of these since 1949. Okay, so it's pretty, it's pretty consistent and it's pretty good data. So this is a rule that was made, and I'm going to kind of show you the chart so you can kind of see what it looks like. All right, so you can see the chart here, and you can see basically all these gray bars going from the bottom to the top are when the recession happened. So the blue lines are the spike in the unemployment rate. So you can kind of see in every spike, somebody called a recession or they were in one at all the gray bars. Okay, so it's pretty consistent. Obviously, every time you see the spike, you see the recession called in the gray bars. So it's a pretty good indicator. And I think right now we're kind of in that window as well. So I think you can expect that they're going to call that. And usually they don't call it for a little while. So a lot of it is rear view mirror type of stuff. But you can definitely tell we're either heading there or we're in it. So here's the actual numbers to kind of correlate that chart that we just looked at. So if you look at the unemployment rate, the lowest number that was on there was a June of 23 number, which was 3.6. They just called the unemployment at 4.1 in June of 24. So there's your 0.5% on the run here. So if we get a 4.1 in July and August or higher, they're going to say, hey, we're in it or we're about to be in one. So those are the actual numbers that we're searching at. And right now we're sitting at 4.1. All right, so here's the corresponding chart for what happens to interest rates. So understand this, the recession, though it sounds bad, is not a bad thing from an interest rate perspective. Okay, so recessions are good for interest rates. If you look back in, again, the gray bars of the recession, the blue line now in this chart is interest rates. So every time you see the recession bar, interest rates are plummeting. Okay, every time. So I think one of the things to kind of be mindful of as you are looking to either purchase today, which, listen, it's not this graphic every time, but we've been telling people, and you've kind of seen it online or whatever, hey, marry the house, date the rate concept, because there's going to be an opportunity for refinance. This is what they're talking about, right? This chart is what they're talking about, meaning, hey, if you buy now, the price is what it is, whatever, and it may be uncomfortable because you're at 7 or whatever you're doing, but there's going to be an opportunity to exit, and you're going to be a lot happier exiting when the prices spike off of a refi than trying to enter when the prices drop off of a purchase. When we all know what happened when rates dropped in 2020 and 2021, houses now are worth 2 to 3 times what they were during that window before the COVID deal happened and before the recession and the interest rate drop happened in that space. All right, hopefully that gave you a little bit of a baseline on, hey, where do we think rates are going? Here's what we don't know. We don't know when, and we don't know how far, okay? What we do know is that there's a pretty good chance we're going to drop, and we've already started to drop. If you look at some of the things like we follow, and we're looking at mortgage-backed securities, and we're looking at the 10-year treasury, if you look at the pattern and you see where the 25, the 50, the 100, the 200-day moving averages are, and you're looking at the stochastics, and you're looking at the, Fibonacci levels and all the other things that we look at to try to determine what the hell's going on, you can see the trend is definitely heading south. And every time that there's a good report or a neutral report, that just is confirmation that we're heading in the right direction from, an interest rate perspective. So what we're telling everybody right now is you need to get your ass ready. So if you're thinking about buying, if you're thinking about refinancing, if you're thinking about any of these things, we don't know when, we don't know how far or any of that stuff. But all I know is that you want to be ready. Okay, because we all know this. They're already saying that a 1% drop in interest rates is going to yield 5 million buyers into the market for every 1% drop that we have. Well, again, like I said in the chart, if you were around in 2021 and, in that 2020, 2021 COVID window, that increase in demand shot prices through the roof. Well, that's not going to be any different this time around, okay? Now, there's going to be some limits because obviously prices have already gone up, et cetera. But, there's going to be an opportunity, and I think the increase in demand is going to push prices up again. So you just need to be mindful of that in your strategies, whatever those strategies are, whether it's, hey, I'm going to buy as an occupant or I'm looking to do something on the investor front because rents are going to rise again, but they're not going to rise at the pace that the house prices do if there's another spike that looks like that COVID window spike did. And I don't think it's going to be that big, but it could, you don't know, right? We just don't know when, and we don't know how far in either direction that we're talking about. So anyway, if you haven't already, please subscribe to the channel. Like the video, shoot it to somebody who has no idea what we're talking about and might be helpful on it. Again, if you have questions or not sure about your situation individually, please hit me up. All my information is in the description below. And look forward to helping you guys, and I will talk to you later.